Okay, we are looking at M3-2, and that is on page 121 in your textbook. So 3-2 deals with identifying accrual basis revenues. If you recall from your reading, we need to recognize revenue when it's in fact earned, regardless of when we get paid for it. So 3-2 says the following transactions are July 2013 activities of Bill's Extreme Bowling, which operates several bowling centers. If revenue is to be recognized in July, indicate the amount. If revenue is not to be recognized in July, explain why. So I'll actually book journal entries here for those instances where we have an entry to book, and I'll kind of expand on the hows and the whys as we go. So our first transaction or potential transaction says that Bill's collected $12,000 from customers for services related to games played in July, and we are in fact in July. So we're collecting $12,000 in cash from customers for services related to games that have just been played. We can think about it as happening, today, yesterday, whatever. So since we've already done the work, we do in fact need to recognize revenue for this transaction. So what we can book is an increase to our cash account for $12,000. If you recall, we increase asset accounts with debits. And then for our credit, we need some revenue account. We can just call this service revenue, game revenue. The title is not necessarily important as long as we understand that it is in fact a revenue account. So any revenue account, we'll just mark with an R here under account classification for revenue. We're increasing that account. Revenues are increased with credits, and that's the same $12,000 there. So let's talk about our financial statement effects. Revenues have increased. As a result, net income on the bottom line will in effect increase. When we look at our balance sheet at the end of the period, assets will have increased from our increase in cash. And on the right-hand side of our balance sheet equation, stockholders' equity will also increase. Remember, these two items go together. As net income increases, so does stockholders' equity. From a statement of cash flows perspective, we consider these collections of day-to-day revenues or regular business operations operating activities. And this, of course, is an inflow since we've collected cash. So here we've recognized $12,000 in revenue for transaction A. Letter B says Bill's billed a customer for $250 for a party held at the center on the last day of July. The bill is to be paid in August. So I'm actually going to start with that last sentence. The bill is to be paid in August. From an accrual basis standpoint, we can frankly ignore this. We're only concerned with when we perform the work, and that determines whether we've quote-unquote earned the revenue and whether we'll record that revenue now. So back to the beginning of that sentence, it said Bill's billed the customer $250 for a party that was held on the last day of July. So the party's gone past. So we do need to record revenue for this transaction. We're not being paid in cash right now, though. So what we say here is that the customer owes us for that payment in August. So we'll book accounts receivable and hope to collect that in August. Accounts receivable is something we quote-unquote own. It's an asset account. So we increase it with a debit, $250. And again, we're recognizing service revenue, game revenue, whatever we're calling that, in the amount of $250. Similar to letter A, we'll have an increased total revenue, which will result in an increase in our net income. From a balance sheet perspective, we've increased our assets. We've also increased our stockholders' equity. And there's no statement of cash flow effects because no cash has changed hands. Moving on to the third one, letter C states that the men's and women's bowling leagues gave Bill's advance payments totaling $1,500 for the fall season that starts in September. So the season has not started yet. We're collecting cash in advance payment for that season. So we've done no work. We're not going to record revenue. Let's talk about what we will record. Well, we've received cash, So we want to increase our cash account in the amount of $1,500. We haven't earned anything yet though, so what we'll book is that unearned revenue account. Remember, unearned revenue is a liability. It's something we owe. We don't owe money to the customer, but we do owe them some future service. So we'll book unearned revenue for $1,500. As you can see, this transaction has no effect on our income statement. No revenue or expense accounts have been touched, so nothing happens there. From a balance sheet perspective, my assets have increased. My liabilities have also increased, so I'm still in balance. And from a statement of cash flows perspective, we call this an operating activity as well. Keep in mind, as we always say, when booking any journal entry, we want total debits equal to total credits. We also want to make sure that our balance sheet equation holds for any particular transaction. So we're okay here on letter C. Finally, letter D says that bills received $1,000 from credit sales made to customers last month in June. So we would have recorded revenue at the time of sale. Now we're just collecting on that obligation from the customer from last month. So we are receiving cash, collecting $1,000. So we'll increase our cash account by that amount. And now we're not recognizing revenue. Again, we would have recorded that last month. Instead, we're decreasing our accounts receivable. We're just collecting on that prior obligation from the customer. From an income statement perspective, nothing's happening. From a balance sheet perspective, assets are increasing and decreasing by the same amount, so we're still in balance. And on the statement of cash flows, we'd classify that as an operating activity as well. And just to make sure this is clear, the entry we would have recorded in June would have been an increase to accounts receivable of $1,000 and then a credit to some revenue account. I'll just put that in parentheses. I guess we were selling some goods, but we'll just kind of hit revenue here for that same $1,000. That would have increased our revenue and net income, and it would have increased our assets and equity here, and there would have been no cash flow effect. So that's what we would have booked in June. Now when we're collecting on that obligation from the customer in July, we're going to record what we booked here for letter D. A decrease to that accounts receivable account and an increase to our cash account. And remember, our key word for recognizing or recording revenue is earned. Have I provided the goods or services to the customer? If I have, I need to record revenue. If I have not, I'll worry about it when I do provide those goods or services. Okay? Similar to what we did in letter C, where we collected advance payment for the bowling league. Hadn't done any work yet, so we can't book any revenue. We need to record some liability account to indicate that we owe some future service. Okay, this is M3-9, which states that the following transactions are February 2013 activities of Swing Hard Incorporated, which offers indoor golfing lessons in the northeastern United States. If revenue is to be recognized in February, indicate the amount. If revenue is not to be recognized in February, explain why. So I'll kind of do the same thing I did for 3-2 here, book journal entries, and then make sure that we expand upon any kind of reasoning we need here. So letter A says that Swing Hard collected $15,000 from customers for lesson services given in February. And again, we are operating in February here, talking about February journal entries. So this is in effect the current month. So we collected $15,000. So we know if nothing else, we need to increase our cash account by $15,000. Now the question is, do we record revenue here? The answer is yes. We have provided the services to customers during this current month, so we have earned that revenue. So we need to book revenue accordingly. So we'll call it service revenue. You could call it lesson revenue, any other kind of revenue you want, as long as it's got that magic word revenue in it. We're increasing that revenue account, which needs a credit. There's $15,000. From an income statement perspective, our revenue's increased. So at the end of the period, my net income will increase as a result. Assets have increased on the balance sheet, as will stockholders' equity via that increase in net income. On the statement of cash flows, we consider these operating activities. And again, the plus just means a cash inflow, receiving cash. The second event says Swing Hard sold a gift card for golf lessons for $150 cash in February. Well, we know that we've received cash again, so we'll go ahead and book an increase to cash for $150. In this case, though, we've received advance payment in essence, right? We're not providing a lesson right now. Someone purchased a gift card, they're going to redeem that gift card later, whoever they gave it to, and that's when we'll provide the lessons. So in effect, we have unearned revenue. Again, unearned revenue is a liability account. We owe future service to a customer as a result of this transaction. They're paying in advance, they're going to collect their service later. This transaction has no effect on the income statement. No revenues or expenses are involved. On the balance sheet, assets have increased, as have liabilities. And again, on the statement of cash flows, we have another operating activity. Now let's pause for a moment and talk about what happens when that customer does redeem their gift card, or whoever it was given to. Let's say the following month, so I'll just mark this as March, the recipient of that gift card came in and got their golf lesson, cashed in that gift card. So what happens is we need to eliminate our future obligation to that customer via that gift card. So we decrease our unearned revenue. Let's assume that's the full amount, one lesson, so $150. And now, since we have provided the services, the lessons, we can recognize revenue. So there's our service revenue or lesson revenue, whatever we want to call that. That's when we'll increase that by the $150. Now we'll see the effect of that on our income statement with increased revenue, increased net income. On the balance sheet, our liabilities have decreased and our stockholders' equity has increased by our change in net income. Okay, I apologize, this should be a decrease there, debiting unearned revenue. No statement of cash flow effects here. No cash has changed hands. So again, letter B, we booked the unearned revenue, that future service we owed the customer. Then when they came in to get their golf lesson, we need to get rid of the liability. We don't owe them anything anymore. And that's when we'll record the revenue, when we actually provide the work. So that was a little detour for B. Letter C states that Swing Hard received $4,000 from services provided on account to customers in January. So here we've provided services in the previous period and just had not been paid for it yet. So now we're collecting on those obligations from customers. So we're increasing our cash by $4,000. And what we need to decrease is the customer obligation to us. So accounts receivable. So all we're doing here is moving around assets. Customer owed us $4,000 for services we'd already provided in a previous month. We're collecting on those now. When I book this transaction here, nothing happens on the income statement. On the balance sheet, my assets move up and down by the same amount, so no net effect. And then on the statement of cash flows, I'd see an operating inflow for that amount. Letter D states that Swing Hard collected $2,250 in advance payments for services to start in June. This is very similar to the gift card situation. We're collecting payment, but we have not provided services yet. So we're increasing our cash by this $2,250. We've not provided any services though, so we owe services to the customer in the future. So we'll book unearned revenue for that $22.50. Again, no income statement effect here. On the balance sheet, we see an increase in our assets and an increase in our liabilities. And on the statement of cash flows, we have another operating inflow. Letter E says that Swinghard bills a customer $125 for services provided between February 25th and 28th. The bill is to be paid in March. So we're not collecting any cash. However, the customer owes us $125. So we'll book an asset accounts receivable for that $125. And this $125 is for services we've just provided. So we have done the work, we've completed our end of the deal, so we need to book service revenue accordingly. Okay, that's a revenue account, again increased with a credit, $125. On our income statement, our revenue increases, as does our net income. On the balance sheet, our assets increase, as does our stockholders' equity, due to that increase in income. No statement of cash flow effects because no cash is changing hands. So again, from an accrual basis standpoint, we always need to recognize and record revenue when it's earned. Earned just means we've provided the goods or the services to the customer, irrespective of when the payment will be received, whether it's in the past, in the future, or in the present. Okay, this is M3-10. And it's also really M3-12, the journal entries. But 3-10 says the following transactions are February 2013 activities of Swinghard Inc., which offers indoor golfing lessons in the northeastern United States. If an expense is to be recognized in February, indicate the amount. If an expense is not to be recognized in February, explain why. So similar to the last couple of exercises, I'll book journal entries and then also kind of add the color commentary about the whys and the hows. So letter F says Swinghard paid $4,750 to its golf instructors for the month of February. So we're in the month of February. We're worried about February transactions. So we're in essence paying $4,750 for the current month's golf instruction. So we do in fact need to recognize an expense here. Again, we recognize expenses in the period in which they're incurred to generate revenue. So paying our golf instructors for February instruction certainly fits that description. So wages expense is a good enough title. That's of course an expense account. We're increasing it, so we need to debit it for $47.50 here. And we're paying in essence in cash. So we'll decrease our cash account with a credit by that same $47.50. Now on the income statement, this would have the effect of increasing our expenses, which would decrease our net income. Our assets have decreased, and our equity will decrease due to that decrease in net income. On the statement of cash flows, we'll simply call this an operating outflow, and we're finished with letter F. Letter G states Swinghard paid $1,750 for electricity used in the month of January. So presumably we already received a bill in January, we just hadn't paid it yet. So we would have recorded the expense in January, not here in February. So what would happen is we'd say, well, we would have booked accounts payable or utilities payable in January when we received that bill. Now we are eliminating that liability. So I'm going to decrease my accounts payable account by the $1,750. And I'll decrease my cash account as well. $1,750. Nothing happens on the income statement. No revenue or expense account is involved. On the balance sheet, my assets have decreased. My liabilities have decreased. And on the statement of cash flows, again, we'll call this an operating outflow. It's our day-to-day type activities. So So here in letter H, we'll see kind of the first half of what would have been part of that transaction G. So H says Swinghard received an electricity bill for $800 for the month of February to be paid in March, the following month. So again, we always record or recognize our expenses in the month in which they're used to generate revenue. So I need to record an expense in the month that I get the electric bill here. So I'll have utilities expense. Oops. It's an expense account increased with a debit for $800. I'm not paying it now though, so I don't want to credit cash. Instead, I want to credit that accounts payable and indicate that I in fact owe the utility company payment in the future. So I need to increase my liability account here with a credit. Again, $800 is the amount. From an income statement standpoint, my expenses have increased, so my net income will decrease. On the balance sheet, my liabilities have increased. My equity, stockholders' equity, has decreased. And no cash flow effects because no cash changed hands. And that's it for 3-10.